we have seen enough of a cooling of business conditions, of a cooling of the labor market, that the Fed is probably or will likely cut interest rates in September and is expected to cut interest rates one or two more times in November and December.
This is Converge,
a podcast from Convera.
Come with us as we shape the future of finance. Welcome to yet another Converge market update. It is July 31st. We are more than halfway through the summer, or about halfway, depending on how you look at it. But it's obviously been an eventful summer, but also sometimes not eventful. So, Boris, most of us have been expecting things to calm down during the summer. July and August tend to be less liquid, less volatile. People usually go on holidays. Needless to say, that anticipated slowdown is actually not happening right now. So can you give us some picture of what's going on in the markets right now?
Yeah, for sure. I mean, pleasure to be back, Alex. So I think you make quite a fair point. I think analysts have written quite extensively about this summer lull. But the truth is that we're just living in a very complex and complicated market environment that doesn't really lend itself to these quiet months. Central banks are kind of at this crucial turning point, going from the global tightening cycle that we're used to in the post-pandemic era to now the easing cycle commencing. And while they're also trying to engineer this soft landing, so policymakers continue to be unusually data dependent, and there is a significant uncertainty band around our inflation and labor market forecasts. So of course the incoming data matters, even if it's summer for us in Europe going on holiday. And if you then add the US election on top of that, you of course get volatility. We recently also published a piece on the top 10 most important developments in July, and it's a list that would usually fill whole quarters, if not half a year. So from the Trump assassination attempt to Biden dropping out of the presidential race, Fed cuts being put back on the table by investors due to this weaker growth environment. Then you had the yield curve uninverting again, the Japanese yen going on a tear in the FX markets, and then in Europe, the recovery stalling, and China at least trying to put the economy back on track. So you see, it was quite an eventful start to the second half of 2024.
Yeah, it definitely seems like it, but I would argue what is probably more important at this stage is that you're not expecting August to be any different. Or do you? I mean, you publish a global macro calendar every month, and it's once again packed with a lot of high-level data and political events on that calendar. So what should we keep in mind going into the month?
Yeah, so we generally tend to look at the upcoming month from these two perspectives, I would say. First, we ask the question, which individual events are likely to cause volatility going forward? And then how can they shape up into these bigger themes or narratives that will drive markets just beyond a day or a week? And I would already say that I alluded kind of to it in the beginning. We are definitely at a turning point in monetary policy. So while we only have two major central bank decisions in August, one of them already happening on Thursday in London with the Bank of England, the macro data will be important to gauge what these central banks will do in September. And the meetings then will be crucial because most central banks will publish their quarterly forecasts, and both the Fed and the ECB are expected to cut rates in September. Another, I think, interesting point that we noted is that in August, the month will be decided in just 8 trading days between the 13th and the 22nd. And this is where all the data for example, the United Kingdom will be published. We'll get the big macro patch from China, European PMIs, wage data, plus inflation in the US. On the political front as well, we'll have the Democratic Convention that will most likely make Kamala Harris the official candidate. And then we have the Jackson Hole Symposium on the monetary policy front, which is of course organized by the Fed, and where many global central bankers take kind of stance on certain policy recommendations. And this is kind of seen for markets as a guidance on where monetary policy is headed. And I think the main question going into all of this, going into August, is how much is the US economy really slowing? Will inflation continue to fall? And then are the September cuts a done deal as markets are expecting? Or is there some fluctuation on, how much room central banks have to maneuver here?
So, can we preemptively focus on one of those questions you raised? Because there have already emerged signs of the US economy at least losing some steam, but GDP growth for Q2 still outperformed expectations, and consumer spending still seems robust. So, are we in a place where we can't even tell if the US economy is slowing or not?
Yeah, I mean, it's really a tricky one for economists, I have to admit, because I think it was clear that the US economy could just not outperform its peers to such a large extent indefinitely. And while the lagging data continues to be resilient, I think you pointed to the strong 2.8% GDP print for Q2 as an example. There have emerged, I would say, some signs of a weakening momentum in spending and consumer health. So the labor market is clearly cooling, looking at job openings and the quits rate, looking at the unemployment rate rising from 3.5% to 4.1%. And it doesn't help that credit card debt is at an all-time high of around 1.1 trillion US dollars. That delinquency rates, so overdue bills that consumers have to pay interest on, have soared to 30-year highs for small banks in the US. And that, of course, these excess savings from the pandemic have dried up. So I would argue it's not about the US economy being weak by any mean. It's that the consumer is now more sensitive to these external shocks, to a weaker economy, and the likely continued softening of the labor market.
And do you think that is enough to finally tip the Fed into this long awaited easing cycle?
Well, markets seem to be quite certain about the Fed cutting in September. There's an 88% chance or probability priced into options markets, and investors even see 7 rate cuts for the next 9 meetings of the FOMC. So significant easing that is, of course, reflected in this market expectation, which is why the 2-year Treasury yield is almost back at where it started the year at around 4.3%, which is down significantly from its 5% peak reached in May. So I would argue we have seen enough of a cooling of business conditions, of a cooling of the labor market, that the Fed is probably or will likely cut interest rates in September and is expected to cut interest rates 1 or 2 more times in November and December.
Okay, great to hear. So I imagine policymakers in Japan and China are very welcoming of this development. We talk extensively about the weaknesses of the yen and the yuan in recent episodes, but it seems that the selling pressure has sort of evaporated. How much of it is just down to the Fed and lower US yields?
Well, I would say most of it, because dollar yen has been the most watched currency pair, I would argue, in the world for quite some time, but especially this week with both the BOJ, the Bank of Japan, and the Fed meeting. So the pair has briefly been up around 15% year to date and has peaked 4 weeks ago. And since then, it came down 6%. And as you said, it's mainly a function of lower yields in the US, of expectations of the Fed starting its easing cycle in September, and US growth weakening on a broader basis. But we have to keep in mind that the Bank of Japan also raised rates this week, just for the second time in 15 years, to now 0.25%. And in anticipation of this tightening of policy in Japan, investors have closed down their short positioning on the yen, which also alleviated some pressure off the currency because investors have been so bearish on the Japanese yen. And this is why I think the Japanese story or the Japanese yen story of the last couple of weeks is a function of these both factors being at play. The first one being the US story, weaker growth and lower yields. But on the second side, also the expectation that wages will continue rising in Japan and that you'll see at least 1 or 2 rate hikes more from the Bank of Japan.
Okay, got it. So a last question is on Europe. We just received the CPI and GDP numbers this week, both pointing in somewhat opposite directions. The German economy shrank in Q2, but the outperformance from Spain and France helped the Eurozone grow by a solid 0.3%. Inflation did not come down as much as expected. How does this change the ECB's plan to cut in September, if at all?
Yeah, I mean, there's quite a lot of disagreement of opinion from both analysts and the ECB members themselves on how much the central bank should ease policy. And you, of course, rightfully pointed out the main divergence in opinion, which is this split between Germany and Spain, for example. So you have these splits between economies that have underperformed and outperformed. And of course, the Eurozone, the European Central Bank, tries to accommodate most of its members. But if some of them point in different directions in terms of growth momentum and inflation momentum, it's really hard because you have arguments for both cutting and raising interest rates at the same time. And as I said, Spain and Germany are the best examples because GDP for Spain and France came in better than expected, but it came worse. It came in worse than expected for Germany. So the German economy actually shrank on a quarter-to-quarter basis in Q2, slightly, but still. And if you compare it with a strong growth in Spain, it tells you how much the divergence has played out here. And the same picture is true on the opposite side on inflation. So German CPI beat the consensus estimate, but Spanish and French inflation came below forecasts for the month of June. And I still think that the ECB will probably take the opportunity of the Fed cutting in September as well to ease policy, because there have emerged a couple of signs, I would say, of, for example, the labor market starting to cool a bit. And with Germany, and especially the construction sector in Germany remaining weak, bankruptcies on the rise, some easing from here on will definitely be justified. But as I said in the beginning, August will definitely be a market-moving month. It will give us a lot of data to point the ECB in one or the other direction for its September rate decision.
Well, excited to see how August plays out as we roll towards another September and fall season. Boris, thanks again for breaking the news down this week. We'll see you next time.
Well, always a pleasure, Alex. Thank you.